The Airbnb gold rush is dead. Half of all short-term rental properties in America are now sitting empty, and desperate owners are flooding the market trying to sell. Global occupancy rates have collapsed to just 48%, well below the 55% minimum needed to break even. While entry-level properties in major markets like Austin are achieving a catastrophic 24% occupancy rate. In Galveston, Texas alone, the number of homes for sale exploded 42% in just 1 year, as panicked Airbnb owners rush for the exits. Here's the brutal reality from the most recent market data. The global average occupancy rate has fallen to just 48%, while desperate property owners flood the market with listings they can't fill. If you bought into the Airbnb dream during the pandemic, or you're thinking about jumping in now, you need to understand what's really happening in this market before you make a decision that could cost you hundreds of thousands of dollars. We're going to walk you through the actual data from the past 6 months that shows exactly how the short-term rental industry went from pandemic goldmine to financial disaster, and more importantly, what this means for your investment strategy moving forward. Because while everyone was talking about easy money, the numbers were telling a very different story. Let's start with the occupancy crisis that's hitting property owners nationwide. According to the latest spring 2025 data from Mashvisor, national occupancy rates have fallen a devastating 7 percentage points in just 1 year. Think about what that means for your bottom line. If you were counting on 57% occupancy to make your mortgage payments, and you're now sitting at 50%, that's not just a small dip, that's the difference between profit and loss for most properties. The global picture is even worse, with the worldwide average occupancy rate now sitting at just 48%. This isn't a temporary adjustment, it's a fundamental shift in how the market operates, and it's happening right now. The supply and demand imbalance has reached critical levels. New listings continue to flood markets faster than demand can absorb them, creating oversupply conditions that are crushing individual property performance. Current revenue data from major markets tells a concerning story. In Galveston, with 6,413 active listings as of March 2025, the median host income is just $31,000 annually. Miami properties, according to recent data through March 2025, average $35,873 annually. Austin properties at the median level are generating around $2,559 per month, which translates to roughly $30,700 annually. These are gross revenue figures before factoring in mortgage payments, insurance, taxes, maintenance, cleaning costs, and all the other expenses that come with property ownership. When occupancy rates are sitting at 46% in Galveston, 49% in Miami, and as low as 24% for entry-level properties in Austin, these revenue levels don't often cover basic operating expenses, let alone generate profit. Let me take you to Galveston, Texas, because this market perfectly illustrates what's happening across the country based on the most recent data. With 6,413 active short-term rental listings as of March 2025, the median occupancy rate has collapsed to just 46%. The median host income? $31,000 annually. That's before expenses, before taxes, before all the costs that come with owning and operating a rental property. But here's where it gets really interesting for investors and home buyers. Property inventory for sale in Galveston has surged 42% year over year, hitting about 1,000 listings in the first quarter of 2025, according to the Houston Association of Realtors. The number of registered short-term rentals has more than doubled since 2021, growing from 2,300 to 4,900 properties as of March 2025. That's a massive oversupply situation. The real estate market fundamentals are deteriorating rapidly. The average sale price of homes in Galveston dropped from $564,610 in 2024 to $526,506 in 2025. Meanwhile, the number of sold homes plunged from 918 in 2023 to 723 in 2024 and 123 as of March 25, 2025. Properties that used to sell in weeks are now sitting on the market for months. We can give you a specific example that shows just how desperate some sellers have become. There's a 6-bedroom restored home in Galveston that represents hundreds of thousands in restoration investment since 2012. This is interior work. According to recent reports from May 2025, properties like this are sitting on the market for extended periods without generating serious buyer interest. That's the reality of today's market. The financial pressure on these property owners isn't just coming from poor rental performance. Property values in Galveston surged 47 to 49% over 5 years, meaning many owners are carrying massive mortgages based on inflated pandemic pricing. The county started treating short-term rentals as businesses in 2024, adding furniture and personal property taxes. Home insurance premiums rose 23 to 26% between 2019 and 2023. Vacation rental properties get no homestead tax exemptions. It's a perfect storm of increased costs and decreased revenue. Austin, Texas tells a similar story with recent data from June 2024 to May 2025 showing 9,110 active listings in an increasingly competitive market. Entry-level properties in Austin are averaging just 24% occupancy, which is below any threshold for profitability. The median properties in Austin are generating around $2,559 per month, but that's gross revenue before all expenses. What's particularly concerning is that these numbers represent a market that was supposedly one of the strongest for short-term rentals. When even Austin, with its vibrant tourism, tech industry, and cultural attractions, is showing these kinds of occupancy challenges, it signals fundamental problems across the entire sector. Miami shows concerning trends in recent data from April 2024 to March 2025. With 7,182 active listings averaging 49% occupancy. That's below the 55% threshold that most analysts consider necessary for profitability. The average annual revenue is $35,873, but again, that's before expenses. Miami Beach is performing even worse, with recent data showing just 43% occupancy despite its premium beachfront location. Please take 2 seconds to help us out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now let's continue. These aren't small markets having temporary problems. These are major metropolitan areas experiencing fundamental oversupply during what should be peak tourist seasons. Now let's talk about what this means for profitability, because this is where the easy money promise completely falls apart. Recent market analysis shows that a significant portion of short-term rental owners are struggling to maintain profitability in the current environment. With occupancy rates at 50% nationally and as low as 24% for entry-level properties in major markets like Austin, the math simply doesn't work for most property owners. Current data from spring 2025 shows that properties in markets like Galveston are generating median revenues on just $31,000 annually, while Miami properties average $35,873. When you factor in mortgage payments, insurance, taxes, maintenance, and cleaning fees, these revenue levels leave little room for actual profit. Competition has intensified dramatically across all markets in 2025. In Galveston alone, the doubling of short-term rental registrations from 2,300 to 4,900 properties since 2021 has created a saturated environment where there are simply too many properties and too few vacationers to fill them, according to local market experts. This oversupply pattern is repeating in markets nationwide. The current market shows distinct performance tiers. In Austin, top-performing properties achieve $7,186 plus monthly revenue, but entry-level properties are struggling with revenues around $1,257 monthly and occupancy rates of just 24%. This creates a winner-take-all market where only the best-positioned properties can generate meaningful income. The financing environment has become increasingly challenging for property investors. Investment property financing continues to carry rates 0.5 to 0.75% higher than primary residence mortgages, with most lenders requiring 25% or more down payments. The elevated cost of capital combined with declining rental performance creates a difficult equation for new investors. Properties purchased during the pandemic boom are particularly vulnerable. In Galveston, where property values had surged dramatically, the combination of high purchase prices, elevated mortgage rates, and declining rental income has left many owners in financially precarious positions. Recent data from spring 2025 shows this isn't isolated to a few markets. The pattern of declining occupancy and oversupply is appearing across multiple regions. Austin's entry-level properties struggling with 24% occupancy, Miami averaging 49% occupancy, and Galveston sitting at 46% median occupancy, all point to systemic challenges rather than localized problems. Even Miami Beach, traditionally one of the strongest short-term rental markets in the country, is showing 43% occupancy according to the most recent data. When premium beachfront destinations can't maintain the 55% occupancy threshold needed for profitability, it signals fundamental market weakness. The regulatory environment has become increasingly hostile to short-term rental operations. New York City's restrictive regulations require host presence, effectively eliminating most short-term rental operations and causing a 46.1% decrease in demand. San Diego projects cutting its current 12,300 rentals nearly in half through new regulations. Cities across the nation are implementing registration fees, hotel taxes, business license requirements, and zoning restrictions that make previously profitable properties unviable. Let me put the cleaning and operating cost situation in perspective because it's often overlooked in profitability calculations. Cleaning costs continue to represent a significant portion of gross revenue, typically ranging from $200 to $400+ per property turnover. When you're already struggling with 50% national occupancy and properties in key markets sitting at 24 to 49% occupancy, having substantial cleaning and operating costs significantly impact your bottom line. The combination of lower occupancy rates and fixed operating costs creates a devastating squeeze on profitability. Properties that might have been marginally profitable at 60% occupancy become significant money losers at 45% occupancy, even with the same nightly rates. Major property management companies are reflecting the industry's struggles in their recent performance. Industry consolidation continues as companies that specialize in short-term rental management face pressure from oversupplied markets and declining property performance. When the companies that are supposed to be the experts in this business are struggling with market conditions, it raises serious questions about individual property owners' ability to succeed. The economic impact extends far beyond individual property owners. The U.S. short-term rental market, valued at $68.64 billion in 2024, faces headwinds that threaten projected growth. Employment in leisure and hospitality maintains a 6% unemployment rate compared to the national average of 4%. Construction and development activity has slowed dramatically due to high interest rates and reduced demand. Here's what the current data tells us about the immediate future. Supply continues to outpace demand in most markets, with new listings appearing faster than the market can absorb them. The spring 2025 data showing 50% national occupancy and even lower rates in major markets suggests this trend is accelerating rather than stabilizing. Current market conditions show occupancy levels well below the 55 to 60% typically needed for property profitability. Interest rates, despite recent Federal Reserve adjustments, remain elevated, enough to constrain new buyer activity and refinancing options for struggling property owners. Properties purchased during the 2020-2022 boom face particular challenges because owners often paid premium prices based on unsustainable pandemic-era performance projections. The combination of oversupply, increased competition, regulatory restrictions, and elevated operating costs has created what industry observers describe as a new normal that requires significantly more sophisticated management and realistic financial expectations. For investors and home buyers watching this market, the key takeaway is that the short-term rental industry is undergoing fundamental restructuring, not temporary adjustment. The easy money promised during the pandemic was built on unsustainable conditions. Travel restrictions that forced domestic tourism, low interest rates that inflated asset prices, and regulatory environments that hadn't yet caught up to the explosive growth in short-term rentals. The most recent market data from spring 2025 reveals an industry undergoing fundamental restructuring rather than temporary adjustment. With national occupancy at 50%, major markets like Austin seeing entry-level properties at 24% occupancy, and dramatic increases in properties for sale, the short-term rental market faces challenges that extend far beyond typical cyclical downturns. Current conditions show that nearly half of properties are struggling to maintain viable occupancy levels. Property inventories for sale have increased dramatically in key markets, and occupancy rates remain well below sustainable levels. This represents fundamental market stress that requires more conservative projections, better management practices, and realistic expectations about future performance. The numbers don't lie about what's happening right now. The Airbnb easy money era is over, and the market correction we're seeing reflects true economic short-term rental operations in a normalized, oversupplied environment. If you found this video interesting, please subscribe, share, and watch this one as well.